Hello everyone, welcome to another weekly chapter. This chapter will focus specifically on quarterly shifts and IPDA. This is an important time-related concept, a higher time frame concept used to build a narrative for effectively generating trading ideas on new higher time frame biases. As ICT or CRT traders, we believe that the markets are driven by an algorithm. The movements we observe in the markets are not random at all. The reason we hold this belief is that if all market movements were random, then the concepts we have learned, ones that have worked in the past based on our data, would have no guarantee of working in the future. If something is completely random, there is zero chance of turning that randomness into an edge that could consistently bring profits in the long run. The probabilities of success would never be in our favor. That would be gambling, not trading. Our job as traders is to identify sequences, themes, or patterns in the markets that provide us with an edge. This is only possible if the markets operate through an algorithm. If we accept that the markets are run by a specific algorithm, it follows that market movements occur through particular sequences, rhythms, or themes. By collecting extensive data, we can identify patterns that repeat over time. If we can accurately recognize these patterns with a reasonable degree of accuracy, we can use them to our advantage and develop an edge in trading. That said, it is not entirely possible to identify all market sequences and phases. It is simply not feasible to determine every single market swing, as the algorithm governing market movements is constantly evolving. It is an incredibly complex system, and we must acknowledge that we cannot completely outclass or outsmart it. The probability of doing so is zero. However, what we can do is identify specific sequences that work consistently over a large track record of data. Using this information, we can establish rules and protocols that allow us to exploit these patterns while employing proper risk management. Over the long run, by trusting our system and following our trading plan, we will remain profitable. The reason this works is that we have identified an edge that has consistently proven effective in the past. By collecting data and using proper risk management and risk-to-reward ratios, we can ensure long-term profitability at the end of each month, quarter, or year. This is the same process used by traders like ICT, Larry Williams, and other greats who have developed these concepts. For instance, if we believe order blocks work, it's because ICT identified this sequence, gathered data around it, and found that under specific conditions, order blocks consistently function as expected. It's not as though ICT was born with this knowledge. He refined his understanding by learning from previous great traders like Larry Williams, studying their teachings, gaining experience with charts, and repeatedly observing these patterns in real market conditions. Through this process, he identified specific characteristics that define an order block and determined how they behave in various scenarios. The same applies to other trading concepts, including quarterly shifts. If we believe in quarterly shifts, it's because ICT identified and gathered data around this phenomenon, proving that the edge he discovered is reliable in the long run. This reinforces our trust and belief in these concepts. Again, this is only possible if the markets operate based on an algorithm. If price movements were purely random, it would be impossible to identify such patterns or sequences. Another important consideration is that no trader can be correct 100% of the time. However, these concepts allow us to be right more often than not, which is what matters in trading. No system can always provide perfect signals, and losses are inevitable. They are a part of the process, and traders must accept them. In addition to this, we must think in terms of probabilities. Every edge will have some margin of error, meaning there will be times when it produces losses or incorrect signals. This is completely normal and should be expected. Since no system is perfect, losses are an unavoidable part of trading. Furthermore, it is impossible to predict when these losses will occur. Traders should not attempt to skip trades based on a feeling that a particular trade will lose. There is no way to know in advance whether the next trade will be a winner or a loser. Everything is subject to probability. Therefore, we must always focus on long-term performance rather than short-term losses or setbacks. Understanding probabilities and trusting the system is essential. Traders must believe that both wins and losses are randomly distributed over time. For example, If a trading model has a 50% win rate, this percentage is derived from years of collected data. This means that over a significant number of trades, roughly half will be losses and half will be wins. However, the specific order in which wins and losses occur is entirely unpredictable. It's also important to note that win rate alone is not enough to determine profitability. Risk-to-reward ratios must also be considered. Even with a 50% win rate, traders can be profitable if they manage their risk correctly. For instance, if a trader has a favorable risk-to-reward ratio, they can still generate consistent profits despite losing half of their trades. Now that we've covered these foundational concepts, let's return to the main topic of this chapter: quarterly shifts and IPDA. First of all, I'm going to start with an introduction to quarterly shifts, and then we will explore the concept further in the next part of this chapter. The first and most important thing to consider when dealing with quarterly shifts is that it is not a standalone, all-encompassing concept. Rather, it is a tool or idea that can be used in conjunction with other high time frame concepts like seasonal tendencies, key levels, dealing ranges, and market profiles. You cannot use this concept alone. It must be integrated logically with other concepts. Only then will you be able to see how effective quarterly shifts can be. Quarterly shifts are primarily used to gain conviction in existing trading ideas. In some cases, they can also help generate new trading ideas or biases on higher timeframes, but only when all elements align logically. Now you may ask, what exactly are quarterly shifts? First and foremost, do not confuse them with quarterly theory. We are not discussing quarterly theory here. I have no opinion on it, as I have never tried it, but I would advise against it. It is not worth your time. The ICT and CRT concepts are more than enough to help you become a profitable trader. Introducing additional concepts from other sources will only bring in more variables and complicate your analysis. This added complexity will make things worse for you. Stick with what ICT and Lumu have taught and forget about the rest. Now let's talk about quarterly shifts. The core idea is that every 3 to 4 months, there is a significant structural shift or change in the markets. This shift can take multiple forms, but the key principle is that every 3 to 4 months, sometimes exactly 3 months, sometimes 4, there will be a major change in the market structure or order flow. The optimal range for these shifts is 3 to 4 months. While it can extend beyond that in some cases, the general pattern stays within this time frame. Each shift results in a structural change in market behavior, which is what makes this concept valuable. Of course, it doesn't end there. There are many intricacies and important aspects to quarterly shifts that we will discuss further in this chapter. It is not as simple as just marking 3 to 4 months and expecting a shift. There are specific conditions and factors to consider. This concept suggests that markets operate within a particular market profile, structure, or order flow for a maximum of 3 to 4 months. Beyond that period, shifts tend to occur. While this is not a strict rule that applies 100% of the time, it is a consistent pattern that traders can rely on. If you analyze monthly and weekly charts, you will see that markets do indeed follow this behavior most of the time. While there will always be exceptions, the general principle remains valid, and that is what gives us an edge in trading. If you focus only on the times when this pattern did not work and use those instances as an argument against it, then you are not thinking in terms of probabilities. If you skipped the earlier section on probabilities, I suggest you go back and review it. Another key point is that these 3 to 4 month periods are not based on calendar months. Instead, quarterly shifts begin or end based on the most recent month where a new market structure or profile emerged. A quarterly shift has nothing to do with the official quarters of the year. This means that the start of a new structure does not necessarily coincide with the first, second, third, or fourth quarter of the year. It can start or end in any month, depending on price action, structure, and order flow. The quarterly shifts are not tied to the calendar year. That is an important distinction to remember. Now let's move on and explore this concept in more detail. Quarterly shifts are an essential concept in market analysis, but they should never be viewed as a standalone strategy. Instead, they must be used in conjunction with other high time frame concepts, such as seasonal tendencies, key levels, dealing ranges, and market profiles. It is crucial to understand that quarterly shifts act as a tool for gaining conviction in pre-existing trading ideas, rather than being the sole basis for a trading decision. In some cases, they can also be used to generate new trading biases on higher timeframes, but only when all supporting factors align logically. Understanding quarterly shifts requires distinguishing them from quarterly theory, which is an entirely different concept. There is no need to delve into quarterly theory, as it does not add significant value to market analysis. Instead, focusing on ICT and LUMU concepts is sufficient for achieving profitability. Introducing external methodologies only complicates analysis by adding unnecessary variables. The core idea behind quarterly shifts is that every 3 to 4 months, a significant structural shift occurs in the markets. This shift can take multiple forms, but consistently follows the principle that market structures or order flows rarely remain static beyond this timeframe. While exceptions exist, the vast majority of historical market movements adhere to this pattern. By examining higher timeframes, such as the weekly or monthly charts, one can observe that markets tend to transition between different structures within this 3 to 4 month window. It is essential to avoid confusing quarterly shifts with calendar quarters. These shifts do not follow the conventional quarters of the year, but instead emerge based on market structure and order flow. A quarterly shift begins or ends when a new market profile or structure emerges, regardless of the specific month. The timing of these shifts depends on price action rather than arbitrary dates, making it imperative to analyze market behavior rather than relying on predefined calendar periods. By understanding quarterly shifts, traders can anticipate market transformations at specific times of the year. This concept allows for the timing of trends and profiles with greater accuracy. If a market has been following a bearish order flow for the past 3 to 4 months, a major structural change may be imminent. This transition could lead to a bullish shift if price tests a key level or aligns with SMT divergence. Similarly, if a market has been ranging for the past 4 months, a breakout is likely to occur, signaling the end of the consolidation phase and the beginning of an expansion. While quarterly shifts provide valuable insights, they should never be used in isolation. Combining them with key levels, divergences, seasonal tendencies, and other market dynamics is necessary to build a comprehensive and logical trading framework. When multiple confluences align, quarterly shifts can help anticipate significant market movements with a high degree of precision. This integration leads to a more robust high time frame analysis and enhances decision-making regarding market structure and profiles. Another advantage of quarterly shifts is their ability to aid in market timing. Traders can identify when trends and profiles are likely to change, allowing them to make well-informed decisions. This concept brings a time-based perspective to market analysis, enabling traders to anticipate shifts rather than react to them. By leveraging quarterly shifts within a structured and logical framework, traders can refine their strategies and improve the accuracy of their predictions. Every 3 to 4 months, the market follows a dominant profile and structure, meaning it moves within a particular framework for that time period. For example, the market might be bearish for one cycle, and then, after 3 to 4 months, it transitions into another phase, such as a bullish structure. This shift follows a predictable pattern, aligning with structural frameworks that incorporate other key concepts like seasonal tendencies, SMT divergences, and trend dynamics. By understanding this cycle, you can develop new biases and generate high time frame trading ideas. For instance, if the past 3 to 4 months exhibited a bearish trend and price consistently followed a bearish structure, then a major shift could be anticipated when price tests a key level and forms an SMT divergence. This divergence signals a structural imbalance, suggesting that the current price action can no longer sustain its previous trend. If such a shift occurs and the market transitions into a bullish structure, you can then align your outlook accordingly. In this scenario, since the prior quarter was bearish but the recent structural change indicates a bullish shift, you can confidently maintain a bullish bias for the next 2 to 3 months. This allows you to stay ahead of market movements, ensuring your high time frame directional bias remains accurate and aligned with the evolving market structure. Through quarterly shifts, you not only refine your understanding of price behavior, but also enhance your ability to predict long-term directional trends with precision. A common misconception about quarterly shifts is that people often link them to calendar quarters. This is one of the worst ways to approach the concept, because quarterly shifts have nothing to do with calendar months or years. Instead, they are dynamic and depend entirely on price action and seasonal tendencies. Unlike traditional quarterly divisions, a quarterly shift can occur at any time of the year based on market structure rather than rigid calendar-based intervals. Calendar quarters are only relevant when analyzing the yearly range using the open high-low close concept, where each quarter is treated as a distinct phase. However, with quarterly shifts, the focus is on evaluating the current and previous price action to determine the timing of structural transitions. For example, if a new market structure or order flow begins in February, it means the prior 3 months, from November to January, followed a bullish trend. If a structural shift occurs in February, you can anticipate that the next shift will likely take place around May, provided market conditions remain favorable. During this period, from February to May, you can trade within a specific profile and directional bias, fully leveraging the concept of quarterly shifts. This flexible timing approach is crucial because quarterly shifts are based on significant structural changes rather than fixed calendar boundaries. The transition occurs when price action signals a clear shift, allowing traders to adapt and refine their strategies accordingly. To accurately use quarterly shifts as a major confluence and also as a tool to generate higher time frame ideas and biases, you must integrate them with other high time frame concepts in a logical and structured manner. Just like any other trading concept, quarterly shifts are most effective when used in conjunction with other analytical tools rather than being treated as a standalone method. If you approach quarterly shifts, or any concept, as a be-all, end-all strategy, you essentially reduce your analysis to pattern trading rather than making logical, informed decisions. However, when combined with other market principles to build a cohesive narrative, you are engaging in structured, logical trading. The key concepts that should be used alongside quarterly shifts include seasonal tendencies, which is the most important one, followed by high time frame SMT divergences, high time frame key levels, high time frame market profiles, and dealing ranges. Each of these components contributes to refining quarterly shifts into a more precise and reliable trading framework. For instance, seasonal tendencies provide insights into what could happen during certain times of the year. When you combine them with quarterly shifts, you gain the ability to predict or anticipate major structural transitions at specific times. This allows you to time particular market profiles and trends more accurately. By doing so, quarterly shifts help identify when seasonal tendencies are likely to assert themselves most strongly, giving traders an edge in recognizing major shifts in market dynamics. Throughout this chapter, we will explore how to integrate quarterly shifts with each of these high time frame concepts. By doing this, you will learn how to construct well-reasoned market biases and generate trading ideas that align with broader price movements, ultimately refining your understanding of how market structure evolves over time. Now, let's take a deeper look at the framework surrounding quarterly shifts and how you can effectively use them to anticipate market transitions. If a market has been moving within a specific profile or structural order flow for the past 3 to 4 months, then it is highly probable that this structure will come to an end soon. When this happens, a major structural shift is likely to take place over the next few weeks, leading to a new phase in market behavior. For example, if an asset has been consolidating or ranging for the past 3 to 4 months, then based on the principles of quarterly shifts, we can expect an expansion profile in the following months. This is because markets naturally cycle between phases, and after a prolonged period of range-bound price action, an expansion phase is the most likely outcome. To make accurate assessments, it is crucial to use the fundamental principles of market profiles in conjunction with quarterly shifts, aligning them with key levels and broader structural trends. Similarly, if the market has been in an uptrend and showing bullish order flow over the past few months, then a shift toward bearish or ranging price action is more probable in the upcoming months. The reason behind this is that according to quarterly shifts, markets rarely sustain a single profile beyond 3 to 4 months. Instead, they experience shifts where new structures or order flow patterns emerge. Another way to look at it is through a directional bias approach. If a market has been in a bearish order flow for the past 4 months, but last month it transitioned into a bullish structure, then you can anticipate that bullish order flow will continue for at least the next couple of months. This suggests the beginning of a bullish quarter, meaning that your directional bias should lean toward the upside for this period. By understanding and applying quarterly shifts in this manner, you can improve your ability to anticipate structural changes in the market. However, as always, these shifts should be used alongside other confluences such as key levels, market profiles, seasonal tendencies, and SMT divergences to build a solid, logical framework for high time frame analysis. Using quarterly shifts in market analysis provides 2 key advantages that significantly enhance the accuracy of high time frame assessments. First, it helps in determining high time frame drawn liquidity with precision, allowing traders to anticipate where liquidity is likely to be targeted next. Second, it aids in constructing a high time frame narrative and generating a strong directional bias based on structural transitions in the market. These 2 elements, liquidity analysis and directional bias, are the cornerstones of effective high time frame analysis, making quarterly shifts an essential tool for market forecasting. At times, quarterly shifts will serve as a confluence factor, reinforcing existing biases derived from other analytical concepts. However, in other instances, they can be used independently to build and generate new high time frame biases from scratch. By recognizing when a market structure is due for a shift, traders can anticipate potential trend changes and prepare for directional moves well in advance. This adaptability makes quarterly shifts a powerful method for aligning analysis with the evolving market environment. Integrating quarterly shifts with other key market concepts is the most crucial part of effectively applying this theory. As mentioned earlier, quarterly shifts work best when they are combined within a logical framework rather than being treated as a standalone concept. By doing this, we can create sharper narratives and develop more accurate and stronger high time frame directional biases. The primary concepts that will be integrated with quarterly shifts include market profiles, seasonal tendencies, key levels, SMT divergences, and dealing ranges. Each of these elements plays a significant role in refining quarterly shift analysis and ensuring that transitions in market structure are identified with greater precision. In this chapter, I will discuss most of these concepts in detail and demonstrate how they can be combined with quarterly shifts to enhance the overall effectiveness of market analysis. The first step in integrating quarterly shifts with market profiles and order flow, or simply advanced market structure, is to understand that both concepts follow specific principles. Market profiles and order flow each have fundamental rules that dictate how price behaves, and quarterly shifts add an additional layer of structure to these movements. The key here is to combine all of these elements while respecting their fundamental principles and maintaining a logical approach. For example, after a ranging profile, the most likely outcome is an expansion profile. Similarly, after a reversal profile, the most common outcome is also an expansion profile. Understanding these transitions allows us to align quarterly shifts with the natural flow of the market. We also incorporate the fundamental principles of order flow and market structure, rather than ignoring them while applying quarterly shifts. Since we know that every 3 to 4 months, a quarterly shift occurs in market profiles and structure, altering the overall dynamics of price action, we can use these shifts to anticipate the next market profile or structure. If the last 3 months have been bearish, then the next few months are likely to be bullish, forming a bullish quarter. Conversely, if the last 3 months have been a consolidation or ranging profile, we can anticipate the next 3 months to be an expansion profile. However, this isn't done blindly. We also incorporate key levels and other price action tools to confirm the shifts. This is just the first step in the process, with additional steps to refine this analysis further. Another example would be if the last quarter was an expansion profile that tested a higher time frame key level. In this case, we could expect the next quarterly shift to form a reversal profile in the opposite direction. By combining market profiles and quarterly shifts, we can anticipate major reversals and structural transitions over the course of the next few months. giving us a more precise and informed approach to market timing and trend shifts. The graphical representation highlights how quarterly shifts interact with market profiles over 3 distinct quarters, represented in gray, red, and green rectangles. These quarters are not tied to calendar months, but instead span any 3 to 4 month period dictated by market dynamics. The first quarter in the example shows a ranging profile, where price consolidates without significant movement. Based on market profile principles, the most likely outcome after a ranging phase is an expansion phase. Additionally, quarterly shifts suggest that markets typically transition to a new profile every 3 to 4 months. By combining these two ideas, we can anticipate that the next quarter is likely to be an expansion phase. However, this transition should not be assumed blindly. Instead, confirmation is required through lower time frame analysis. A shift in structure on lower time frames, such as a change in state of delivery or order flow, will confirm that the structural shift has begun. Once this is verified, we can expect the market to follow this new direction for the next 3 to 4 months, forming a clear directional bias. Moving on, the second quarter in the example followed an expansion profile, aligning with the expectation after a ranging phase. The next step is to determine the likely outcome after an expansion phase, which could be a retracement profile, a ranging profile, or a reversal profile. The choice among these depends on key levels and dealing ranges. If, during the expansion phase, price tests a significant key level, then the next quarterly shift is likely to be a reversal profile. This is based on the principle that expansion phases often end when they meet strong resistance or support at key levels. Again, before assuming this transition, lower time frame confirmation is necessary, looking for structural changes or signs of reversal in order flow. If no key levels were tested during the expansion phase, then the next quarter would likely result in either a retracement profile or another ranging profile instead of a reversal. The process follows a structured approach by identifying the previous quarterly profile, determining the likely next profile using market profile principles, and confirming transitions using lower time frame analysis before making decisions. By combining quarterly shifts with market profiles and key levels, traders can build a logical, structured approach to anticipating market movements with greater accuracy. In this example, we have 3 distinct quarters, each demonstrating a quarterly shift in price action. The first quarter, spanning from February to April, follows a bearish price structure, meaning the market has maintained a bearish order flow for 3 to 4 months. Based on the principles of quarterly shifts, after a prolonged bearish phase, the market is likely to transition into a new structure. Following this bearish quarter, price undergoes a major shift and establishes a bullish price action phase lasting another 3 months. Since the bullish trend has persisted for this time frame, we anticipate that it will soon reach exhaustion, leading to another structural shift. The key takeaway here is that markets do not maintain the same order flow indefinitely. Instead, they tend to rotate through different profiles every 3 to 4 months, aligning with the principles of quarterly shifts. However, before making any trading decisions, it is crucial to seek confirmation. This confirmation can appear in several forms, such as a structural shift on a lower time frame, a change in state of delivery, CSD, or the testing of a high time frame key level. Additional confluences like a clear retracement structure, CRT, or a turtle soup setup further validate the expected shift. By waiting for these confirmations, traders ensure that their analysis is based on informed and enhanced decision-making rather than assumptions. Here, we have a real-world example illustrating quarterly shifts in action. The price displayed consistent bullish price action for the last 4 months, as seen in the monthly chart, where each candle represents 1 month. According to the principles of quarterly shifts, this prolonged bullish price action is likely to end if the conditions are right. In this case, the bullish order flow led price to test a high time frame opposing key level. Additionally, there was a lower time frame structural shift, providing further confirmation. By combining these factors, we could anticipate that the next 3 to 4 months would transition into bearish price action. This would establish a bearish directional bias for the next quarter, leading to a focus on bearish trades. As expected, the next 3 months exhibited bearish price action. Price first formed a clear retracement structure, CRT, purged liquidity, and then continued to drop for 2 consecutive months. These 3 bearish months confirmed a structural shift in order flow. During this phase, price also tested a higher timeframe key level, the fair value gap, FVG, which aligned with the bearish quarterly shift. With 3 months of bearish price action completed and long-term draw on liquidity positioned higher, quarterly shift principles suggest that the next 3 to 4 months should transition back to bullish. Indeed, price did shift into bullish order flow, validating the accuracy of the analysis. This successful shift was possible due to the confluence of key levels, quarterly shifts, order flow, and market profiles. Again, after 3 months of bullish expansion, price reached a long-term draw on liquidity zone and tested another key level. Based on quarterly shift principles, another transition was expected. Since no market remains in the same order flow or profile for more than 3 to 4 months, the anticipation was for the next quarter to shift bearish. As predicted, price formed bearish price action for the next 4 months, confirming the validity of the approach. This example highlights how integrating quarterly shifts with key levels, market profiles, and order flow principles allows for precise high-time frame directional biases and well-informed trade decisions. Here's another way to analyze quarterly shifts, this time through the lens of market profiles rather than just structure. In the previous example, we looked at shifts in terms of bullish and bearish structural transitions. Now we analyze how market profiles evolve over quarterly shifts. First, price exhibited an expansion profile for 3 to 4 months. According to quarterly shift principles, once an expansion phase completes, the market is likely to transition into either a ranging profile or a retracement profile before continuing in the next phase. As expected, price entered a 3-month ranging profile, consolidating while also testing a key level, further validating the anticipated shift. With this new quarterly shift in place and key levels acting as structural support, the next logical expectation was for price to shift into an expansion profile in the bullish direction. This expansion targeted the high time frame long-term draw on liquidity positioned higher. After reaching the long-term draw on liquidity with this expansion profile, we observed another 3-month expansion phase. Since markets do not typically remain in the same profile for more than 3 to 4 months, a major structural shift was anticipated. Based on quarterly shift principles, the next phase was likely to be a reversal profile rather than continued expansion. As predicted, price formed a reversal profile over the next 3 to 4 months, confirming the accuracy of the quarterly shift framework in guiding high-time frame market transitions. This perspective highlights the importance of integrating market profiles with quarterly shifts, reinforcing that markets evolve in cyclical phases: expansion, ranging, retracement, and reversal, rather than moving in a single direction indefinitely. Here's the price action breakdown on the weekly chart, where you can analyze how price moved in detail. If you're a sharp observer, you'll notice that the major CRTs consistently formed at key structural points, specifically at high time frame key levels. These shifts occurred precisely when significant purges took place, leading to major directional reversals. This pattern is a crucial insight for trading decisions. Major structural shifts tend to align with liquidity events and high time frame levels. Keeping track of where these CRTs form can significantly improve the accuracy of anticipating quarterly shifts. It's worth noting this pattern in your trading journal or notes, as it provides additional confluence when integrating quarterly shifts into your analysis. Integrating quarterly shifts with seasonal tendencies is a powerful way to refine high time frame analysis. One important thing to keep in mind is that this process is not separate from the previous integrations. Instead, each step builds upon the last, forming a logical framework that strengthens our directional bias. The concepts of quarterly shifts, market profiles, and structure are still in play here, and seasonal tendencies add another layer of confirmation. Seasonal tendencies introduce a time-based aspect to market movements, allowing us to align quarterly shifts with historically significant trends. This means that if the last 3 to 4 months have been bearish, but the upcoming months are known for being seasonally bullish, then there is a strong probability of a bullish shift. Quarterly shift theory suggests that markets typically do not stay in one phase for longer than 3 to 4 months. which means that a transition is likely. When this idea is combined with seasonal tendencies that historically favor bullish price action in the upcoming months, the probability of a bullish shift increases significantly. The same logic applies in the opposite scenario. If the market has been bullish for the past 3 to 4 months and the seasonal tendency for the next period is bearish, then it is reasonable to anticipate a bearish shift. The strength of this method comes from combining time-based expectations with structural changes and market profiles, creating a much clearer picture of what the market is likely to do next. By integrating quarterly shifts with seasonal tendencies in this logical manner, high time-frame narratives become more precise. This approach helps traders better anticipate structural transitions, improving the accuracy of directional bias and making it easier to align trades with the broader market cycle. The ability to recognize these shifts and their alignment with seasonal tendencies allows for stronger, more confident trading decisions. Looking at the seasonal tendency chart for EUR/USD, we can see that the pair has a strong tendency to exhibit bullish price action from October through December. This means that historically, EUR per USD tends to rise during the last quarter of the year. By integrating this information with the concept of quarterly shifts, we can enhance our ability to anticipate market transitions with greater accuracy. If the previous 3 to 4 months, leading up to October, have been bearish, then based on quarterly shift theory, the market is likely due for a structural change. Since we also know that EUR/USD tends to be bullish in the last quarter of the year, this seasonal tendency aligns perfectly with our expectation of a quarterly shift in the bullish direction. This confluence of factors significantly increases the probability that euro per US dollar will transition from a bearish phase into a bullish one. To confirm this shift, we would still need to look for structural changes on lower timeframes, such as a shift in order flow, a lower timeframe change of state CSD, or the testing of a high timeframe key level. However, by combining quarterly shifts with seasonal tendencies, we are already forming a strong directional bias in advance, allowing us to anticipate major moves rather than react to them after they happen. This approach provides a clear and logical framework for identifying high-probability setups with increased confidence. This euro to US dollar weekly chart perfectly illustrates the integration of quarterly shifts with seasonal tendencies. The first gray-shaded rectangle represents a 4-month bearish phase where price consistently moved lower. According to the quarterly shift concept, markets do not stay in the same profile or order flow for more than 3 to 4 months. This suggested that a structural change was imminent, meaning a bullish shift was highly probable. Additionally, when we look at the seasonal tendency chart, we see that EUR per USD typically forms bullish price action from October through December. The timing of this aligns perfectly with the quarterly shift expectation. October marked the beginning of a new quarter, and the price action confirmed the shift almost immediately. This confluence of quarterly shift theory and seasonal tendencies allowed for an accurate anticipation of the market bottom, leading to a well-timed bullish outlook. Beyond just price action, this approach incorporates the time element of charts. Instead of merely reacting to price levels, we are proactively timing market transitions using both time and price. Price factors include key levels, order flow, and market profiles, while time factors include quarterly shifts and seasonal tendencies. This fusion enhances our ability to predict market movements with a high degree of accuracy. Furthermore, at the end of the bearish quarter, a bullish CRT formed, serving as a catalyst for the bullish shift. The CRT acted as a key level from which price launched higher. These types of setups, where quarterly shifts align with key levels and seasonal tendencies, are where traders can find the highest probability opportunities, particularly on higher time frames, such as weekly, monthly, or daily. The key takeaway here is mastering the interplay between time and price for superior market timing and precision. This example further reinforces the importance of integrating quarterly shifts with seasonal tendencies and key price action concepts. Here, we again recognize that from October to December, EUR/USD tends to be bullish based on the seasonal tendency chart. However, instead of using standard calendar quarters, we define price quarters. by identifying when a specific market profile or order flow begins. In this case, the bearish order flow started at the beginning of a particular month and persisted for the next 3 to 4 months. This allows us to anticipate a structural shift, as markets generally do not maintain the same profile beyond this time frame. By identifying the shift based on price rather than fixed quarters, we align ourselves with actual market behavior rather than arbitrary time divisions. Looking at the confluences, we see multiple factors supporting a bullish shift. First, the last 3 months have been consistently bearish, signaling that a quarterly shift is due. Second, the seasonal tendency indicates that EUR per USD tends to form bullish price action from October through December. Third, the bearish move took out a range low, providing a natural liquidity sweep and potential reversal point. Lastly, price also tested a high time frame key level, adding another strong technical reason to anticipate a shift. Combining all these factors, quarterly shifts, seasonal tendencies, liquidity sweeps, and high time frame key levels, creates a high probability setup. As expected, the market formed a bottom and transitioned into a bullish quarter. Additionally, we see the presence of a CRT at the bottom, which further confirms the shift in market dynamics. This method of integrating multiple concepts allows for precise market timing and helps traders anticipate major shifts with greater confidence. Instead of reacting to price movements, this approach enables proactive decision-making, significantly improving trading accuracy. The most crucial factor to combine with quarterly shifts is SMT divergence. SMT, smart money technique. Divergence is essentially a discrepancy in price action between correlated assets, signaling non-symmetrical market conditions. This asymmetry indicates that the current order flow is weakening and that a structural shift is likely. The best quarterly shifts occur when a significant SMT divergence is present, as this suggests that the prevailing trend is unsustainable and a transition into a new market profile is imminent. When SMT divergence aligns with a quarterly shift, the probability of a major structural transition increases significantly. If this setup is further reinforced by seasonal tendencies, the level of accuracy improves dramatically. This approach enables traders to analyze the higher time frames in a logical and structured manner, ensuring that their directional bias is well-informed and precise. More often than not, quarterly shifts coincide with SMT divergence, reinforcing the likelihood of a trend reversal. If, for instance, a market has been bearish for the last 3 to 4 months, and a significant SMT divergence appears towards the end of this period in a correlated asset, the chances of a quarterly shift occurring become even stronger. When key levels and seasonal tendencies also align with this shift, the probability of a major top or bottom forming with high accuracy becomes extremely high. By integrating SMT divergence, seasonal tendencies, and quarterly shifts, traders can significantly improve their ability to anticipate structural changes rather than reacting to price movements. This method enhances accuracy and allows for well-timed, high-probability trade setups. This Euro to US dollar monthly chart perfectly illustrates how multiple factors can align to signal a quarterly shift. Since each monthly candle represents 1 month, a sequence of 3 to 4 candles reflects a quarter of price action. In the highlighted grey quarter, the last 3 to 4 months were consistently bearish, establishing a bearish order flow. This prolonged downtrend suggests that, based on the concept of quarterly shifts, a structural transition could be imminent. Additionally, price tested a key level in the form of an order block, adding further confluence. More importantly, an SMT divergence with the correlated asset, DXY, appeared at the end of this bearish quarter. This divergence indicates that the bearish order flow is weakening and that a potential reversal is highly probable. With these 3 strong factors, quarterly shift principles, key level testing, and SMT divergence, the probability of a bullish transition significantly increases. As expected, the market did indeed shift into a bullish quarter, producing 3 to 4 months of upward price action. This alignment allowed traders to anticipate the trend reversal with a high degree of accuracy, ensuring that their directional bias for the next quarter was correct. By analyzing these quarterly shifts methodically, traders can improve their higher time frame forecasting and enhance their ability to position themselves correctly in the market. Looking at the DXY chart, you can clearly see the SMT divergence it formed with EUR/USD. While EUR/USD was in a bearish quarterly phase, DXY showed signs of divergence, signaling a potential shift in order flow. This discrepancy between the two correlated assets further strengthened the case for a reversal in EUR/USD. Since SMT divergence often indicates that the current trend is losing strength, spotting it near key levels alongside a quarterly shift increases the probability of a structural transition. This is why, when combining SMT divergence with quarterly shifts, seasonal tendencies, and key-level interactions, traders can anticipate market turning points with greater accuracy. This example further reinforces how SMT divergence can be a strong confirmation for quarterly shifts. The 3 consecutive bearish monthly candles signaled a bearish quarterly phase, and since markets rarely stay in a single order flow for more than 3 to 4 months, a shift was expected. At the end of this bearish quarter, the SMT divergence with DXY added further validation. DXY took out a high, while EUR/USD failed to take out its corresponding low, indicating non-symmetry in price action. This divergence suggested that the bearish trend was weakening and a structural transition was imminent. By combining this SMT divergence with the quarterly shift concept, traders could have confidently anticipated a bullish reversal for the next few months. The key takeaway is that while quarterly shifts provide the overall framework, additional confluences like SMT divergence, key levels, and seasonal tendencies significantly enhance accuracy in forecasting price movements. Right here, you can see the DXY took out a high and had a turtle soup, a liquidity grab, while EUR/USD failed to take out its corresponding low. This discrepancy created an SMT divergence, signaling that the bearish order flow on EUR/USD was losing strength. Since the quarterly shift concept already suggested a potential transition after multiple months of bearish price action, the SMT divergence further confirmed that a shift to bullish order flow was highly probable. This alignment of multiple factors provided a strong confluence for anticipating the next market phase with high accuracy. All of these are different steps in the same process, and this is exactly how you would use them in a logical framework. By applying these concepts in a structured manner, you can anticipate and adapt to quarterly shifts and use time-based elements, such as seasonal tendencies, to analyze the markets effectively. Now we are using time to accurately identify market tops and bottoms with a great deal of precision. You will incorporate concepts like SMT divergence, seasonal tendencies, daily ranges, market profiles, and key levels to form higher timeframe biases and trading strategies. By using all of these elements logically, you will ensure greater accuracy in your market analysis. This structured approach will help you consistently stay on the right side of the market and maintain a strong directional bias. Ultimately, this method will allow you to build the most accurate higher time frame narratives and directional biases. Moving on, you can see this if-then logical process in action. You will apply this concept exactly as shown. First, you analyze the key IF factors. For example, you check whether the last 3 to 4 months have been bearish, whether they had an expansion profile, and whether there is a major SMT divergence, discrepancy, or asymmetry in price. Next, you consider if the upcoming months are seasonally bullish and whether a discount key level has been tested. Based on these factors, the most likely outcome for price would be a reversal profile with bullish price action. It's a simple yet effective approach. You will use this if-then logic to develop and refine trading ideas. The key is to apply the correct framework logically and systematically. This is the most effective way to do it. Traders, I hope you understand this chapter. If you have any questions regarding this video or CRT in general, please write them down in the comments. Be sure to backtest this or any other trading strategy you find on Flames and Trading. Once you're satisfied with the results, be sure to forward test your favorite strategy on a demo account. Remember that nothing in this video should be considered financial advice. This is purely for informational purposes. If you haven't already, please consider liking this video and subscribing to my channel so you don't miss out on future content. I upload an indicator video every Wednesday and an ICT Concepts video every Sunday. I'm currently making a mini-series on candle range theory, which is what I trade on a day-to-day basis. If you would like to keep up to date with my trades, then follow me on Twitter and join my Telegram. Thanks for watching. Till next time, happy trading.
Would you like to earn up to $10,000 just from sign-up bonuses? How about copy trading alongside professional traders like myself and these experts right here? With ByteFi, it's easier than ever. That's not all, there's no KYC required for all regional users. Plus, you'll enjoy a lifelong 20% cashback on every trade you make. And when you sign up, you'll also get a 10% deposit bonus. This totals 30% of your total trading budget. The link is in the description below.